Welcome to this explainer. Today, we're diving into the absolute bedrock of the global financial system. We're going to break the whole thing down. If you want to understand how money actually flows and functions in the real world, you absolutely have to understand this market. So we're going to unpack exactly how it works step by step. Think about this for a second. What over $1 trillion market quietly pulls the strings behind, well, pretty much everything. We're talking about a market that dictates your mortgage rates, heavily influences whether you keep your job, drives how your investments perform, and even impacts those wild price swings we see in crypto. The everyday stakes here are absolutely massive, yet so many people just don't fully grasp what this market even is. You might be trying to guess what foundational force we're talking about here. Is it the stock market? Nope. Is it Bitcoin? Definitely not. This heavy-hitting force is the bond market. It's often completely misunderstood by the average person, but let me tell you, it's truly the most important, critical piece of the entire global financial puzzle.
Here is our roadmap for today. First, what is a bond? Second, how governments borrow money. Third, understanding bond yields. Fourth, the national debt problem. And finally, bonds versus the stock market.
Section 1. What is a bond? Okay, picture this scenario. You're starting a business. You've got a brilliant, bulletproof business plan. You've got the energy, you've got the passion, but you lack the cash to actually get it off the ground. What do? Well, you borrow from someone who does have the money. In return, you make a solid promise to them. You will absolutely pay them back, and you'll pay them back with a little extra on top. That extra is, of course, interest. That simple, everyday transaction, you being the borrower while the investor acts as the lender, is the exact basic mechanic of a bond.
Section 2. How governments borrow money.
So how does this build when we zoom out from a small business concept to an entire country borrowing money? Well, governments are constantly spending money on big-ticket items like infrastructure, the military, and healthcare. This spending has a really powerful secondary benefit. It stimulates the economy, making citizens and businesses way more productive. And hey, productive people produce tax revenues. This brilliantly illustrates a key point here. A massive 89% of the UK government's revenue comes directly from taxes, leaving only 11% from non-tax sources. When a government spends, it's basically an engine designed to generate tax revenue.
But here is the catch that leads to our big problem. Governments tend to spend a lot more than they actually collect in those revenues. That gap is known as the budget deficit. Year after year, if they spend more than they collect, they add to the total national debt. $36.7 trillion. That is the total U.S. national debt right now. Insane, right? So how on earth do they fund that constant extra spending? By borrowing that money from the public through issuing bonds.
Now, who exactly is stepping up to lend the government all this money? When the Treasury needs cash, it holds auctions, selling these bonds in what's called the primary market. And the buyers are completely global. Banks, insurance companies, pension funds, foreign governments, and yes, even regular people like you and me. They eagerly line up to buy because U.S. government bonds are considered some of the absolute safest investments in the entire world. A default would practically mean the end of civilization and the financial system as we know it, so investors trust it implicitly.
Section 3. Understanding bond yields.
To truly grasp how this market moves and breathes, we need to cut through the heavy financial jargon. Let's do a rapid-fire breakdown of the core terms. First up is the principal. This one is very straightforward. It simply means the initial base amount of money that's changing hands, the exact dollar amount being invested by the lender or borrowed by the issuer.
Next, we have the coupon. This is the interest payment. Actually, scratch that. It's easiest to think of it as the specific annual percentage you're going to receive on that bond. So the absolutely crucial point is this. While other factors in the market might swing wildly up and down every single day, the coupon percentage of that bond always stays exactly the same. It is entirely fixed.
Then we have maturity. You can simply think of this as the time horizon or the ultimate deadline. It just refers to the future date when the loan is completely due and the investor finally receives their original principal money back.
And finally, we have the yield. Now this is where the magic and honestly the confusion for most people usually happens. The yield is the actual real-world return the investor gets from the bond. Unlike that fixed coupon we just talked about, the yield constantly fluctuates. It changes based on the actual price the bond is actively trading for out in the secondary market. To really lock that vital concept in, think of it as a perfect inverse relationship, just literally like a seesaw. If the price of the bond falls, the yield rises. Conversely, if the price of the bond rises, the yield falls. See, investors are constantly buying and selling these bonds on the secondary market based on their guesses about the future. Will the economy speed up? Will inflation drop? Their demand dictates the yield, meaning that overall market interest rates are really just the yield that global bond investors are demanding right at this very moment in time.
Section 4. The national debt problem.
Now that we have the mechanical foundations down, let's explore the terrifying macro-level consequences that unfold when those global bond investors start demanding higher yields. $3 billion. When market rates go up, the cost for the government to borrow goes up right along with them. And because of that massive $36.7 trillion debt we saw earlier, the interest the government has to pay absolutely skyrockets. Guys, that $3 billion isn't a yearly figure or even a monthly figure. That is the staggering interest payment the U.S. government currently owes every single day.
And here is exactly how they attempt to manage that financial nightmare. Step 1. The government issues a lot of short-term treasury bills maturing in just 6, 12, or 18 months. Step 2. Because they rarely have the cash on hand to actually pay it off, they are forced to constantly reset or roll over the debt when those short terms mature. Step 3. They end up having to borrow even more money just to pay off the compounding interest. This vicious cycle eats up more and more of the country's GDP, leaving less and less money available for critical public services like healthcare, infrastructure, and military defense. It is a massive, compounding problem for our future.
Section 5. Bonds versus the stock market.
Let's bring it all home and connect the dots to show how the movements of the bond market directly manipulate your other investments. Let's compare these assets directly. Government bonds offer a guaranteed return, what we call the risk-free rate, because, as we established, the government is highly unlikely to ever default. Stocks, on the other hand, represent a small piece of ownership in a company, carrying a much higher risk of plummeting if things go wrong. The extra return investors expect for taking on that risky stock is called the equity risk premium. Now, when bond yields rise, making that safe, risk-free rate much more attractive, that equity risk premium shrinks. What happens next? Investors start dumping their riskier stocks to buy those highly attractive, extremely safe bonds instead.
And we see a very similar dynamic playing out within the bond market itself. Here we have safe government bonds contrasted against risky corporate bonds. Companies, completely unlike governments, can and do go bankrupt. When there's fear in the wider market, investors demand much higher interest rates to take on the elevated risk of holding corporate bonds. The gap between the interest rates of these two types of bonds is called the high-yield spread. When you see that gap significantly widen, pay close attention. It is a major red flag signaling serious trouble and deep fear in the financial markets.
So, as we've seen in this explainer today, the bond market isn't just a mirror reflecting the economy. It actively shapes it. When interest rates go up, it essentially hits the brakes on the entire global economy. Which brings us to this final provocative question. If this market dictates interest rates and essentially runs the world, exactly how long can governments continue to roll over and compound their massive daily debt before the entire system breaks? It's a fascinating, high-stakes reality that proves if you don't understand bonds, you really don't understand money. Thanks for joining me for this explainer. Keep learning, and I'll see you next time.